question that I wanted to ask is what drives the stock market? Is it fundamental factors like inflation and dividends and profits, or is it emotions? And so what I needed for this was a strong measure that affects people's emotions but doesn't affect a country's economic fundamentals. So the efficient markets hypothesis argues that what drives the stock market are factors that only affect a company's economic fundamentals. So news about inflation or unemployment should affect a company's stock price. But instead, behavioural finance argues that it's not just affected by rational factors, but by psychology. So what I found after studying 1,100 soccer games was that after a country is knocked out of the World Cup, the market falls by 0.5% the next day. Now you might think 0.5%, is that a big deal? But apply to the UK stock market, that is £10 billion wiped off the market on a single day. Here this is a 0.5% move, even though nothing has happened to the economy. Prior studies shows that when England lost to Argentina in the 1998 World Cup on penalties, heart attacks shot up over the next few days. So people actually died because of the sports results. So because sports have such a large effect on people's emotions, we expect that it will be something that drives the stock market. And also we can look at, well, where is the effect stronger or weaker? So we find the effect is stronger in the World Cup than in the European Championship, which makes sense. The World Cup is the largest stage. And it's also stronger in the soccer crazy countries. So England, France, Germany, Spain, Italy, Argentina, Brazil. The effect is stronger in those big 7 countries. So I believe that soccer has the much larger potential to have large impact. And this is for 2 reasons. Number one, soccer is just much more important to a country's national mood than Olympics. So people care more about the national soccer team than, say, with all due respect, say, synchronized swimming or the fencing team. Second is that the soccer event is one game which happens on one particular day. Whereas with the Olympics, it might be that a loss in one competition is offset by a win in the other one. We found that the effect was stronger in small stocks rather than large stocks. And this may be because small stocks are traded predominantly by individual household investors, whereas large stocks are traded more by hedge funds and professional investors. Also, large stocks may be traded internationally. So if, say, a UK large stock was held by an American investor, they might not care what happens to the UK soccer team, whereas small stocks are traded more by domestic individuals. So while I do find a strong negative effect of a loss, I find no positive effect of a win. And so this could be for 2 reasons. So number one is the asymmetry of the competition format. So if you win, you're just through to the next round, but if you lose, you're instantly eliminated. And the second is that supporters are always optimistic about their team's chances of winning. So if you do win, you're not too surprised, so there's no real effect, but if you lose, you're bitterly disappointed. So every year since 1966, England has always thought we're going to win another big major competition. Unfortunately, this hasn't happened despite the optimism, although maybe this year things will be different.